Good morning, everybody, to this session on understanding the political economy for water infrastructure. It's a session which is hosted by the Dutch Director General for International Cooperation, AEGIS, represented by Pim van der Male, and also the German cooperation. My name is Daniel Nordmann. I'm working in the water policy program of GIZ. Although I'm seconded at the moment to KfW, so I'm working on water and finance at the moment. And I have also another colleague here. Please switch off your microphones if you're not speaking. I don't know, is the mic on? Maybe just make sure you.
Daniel. Yeah. Daniel, can you make me a presenter, because I'm supposed to take care of the back end, but I'm only attendee.
Okay. Sorry, yeah. I'm moderating the session together with Katrin Gronemeyer. She will take care of the chat. You will hear my voice most of the time. And before we dive into the contents of this session, I would just like to remind you of the rules we have for all our sessions. So I guess you're already familiar with it. Please mute yourself while it's not speaking. That's, I think, very important. And the session is recorded. So if you're not d'accord with being recorded, please leave the session. I would like to ask the panelists and speakers, once they speak up, to turn the cameras on. But for all the others, just turn your camera on whilst you're speaking, maybe during the Q&A and the discussion, just in order to avoid too much data traffic. What is ahead of us during the next roughly 90 minutes? After a few introductory words from Pim van der Male, to whom I will hand over in a minute, we'll have a presentation of the study on the political economy for water infrastructure given by the Rebel Group, by Rolf. And then we'll have a short Q&A and the panel discussion, which is at the center of this session. And then Bill Kingdom and Pim van der Male will outline a bit the way forward based on what we learned and discussed during the session. I won't now introduce all the panelists and speakers to you. I just wanted to give you an overview who's actually in this session as a speaker. Once we get to the panel, I will introduce the panelists individually. And for now, I just would like to hand over, Pim, to you for a few introductory words. Why we have this session. Pim, you're, I think, a policy officer, right? Responsible for water and sanitation at DGIS. Thank you.
Thank you, Daniel. Yes, hello, everyone. That's correct. I've been with the ministry for 15 years and over the last decade involved in water sanitation and hygiene. And over the last couple of years, working on utility reform and increasingly on finance. So it's very nice to be in this meeting. I was requested to give a bit of a backdrop to what we will be discussing today. The backdrop, of course, are the Sustainable Development Goals and the challenges we have identified to cover the finance gap to achieve the SDGs. We all know, and it's been known for a while, that we need more financing from new sources, for example, more domestic private finance to complement the current public sources used for financing the sector. And it actually turns out that making that transition is quite complex and hard to achieve. At the same time, the clock is ticking, and we only have 10 years to go until we reach 2030. Current financing of capital investments is in the water sector is dominated by public finance, either from donors or the national governments, and also from development finance institutions, often in the form of hard currency, sovereign guaranteed loans. And this meeting actually builds on earlier work done, commissioned by the German and Dutch governments by Rebel Group, into the study into the true cost of development finance, which was also discussed last year in Stockholm. And that study indicated that the current forms of development finance in the form of hard currency, sovereign guaranteed loans can, depending on the on-lending conditions, can turn out to be quite expensive for the local taxpayers. Now, with the previous study and this one, we really want to fuel a strategic debate on rethinking the way we could finance the sector, moving closer to reaching the SDGs. The current study identifies some of the drivers behind finance and investment decisions around water infrastructure, and knowing those incentives can really help us to identify the knobs we can turn to bring some of the thinking around this into practice. So apart from the objective which you've read,
Pim, you muted yourself. Just check your microphone.
no, I actually, sorry. When anyway, let me rephrase the last couple of bullets. I'm not sure when my microphone was cut off, now, I was saying that with this particular study, we get a little bit of a better picture about the incentives of the different stakeholders involved in terms of the decision-making about financing the sector. So knowing these things really can help us to bring some of the thinking around this in practice. And that's what I wanted to conclude, is saying that apart from the objective of the meeting to achieve a better understanding about this topic, I also really hope that we can take the next step and collectively turn this understanding into practice and transform the way we finance the wash sector. Thank you very much.
Thank you, Pim, for these inspiring introductory words. I would suggest that we then move directly to the presentation given by Rolf Dausgaard from Rebel Group. Rolf is heading or is a director of Rebel. He works a lot on infrastructure financing, fund design, in several infrastructure sectors. So probably we can also benefit from that. And he's heading also this assignment. Before Rolf, you start, just let me admit that when I was preparing the slide, I realized that we have quite a male bias in this session. And I promise next time, Philip, isn't it, will do better on that. It's something I was a bit surprised, but which we couldn't change in the last minute. Okay, Rolf, I hand over to you. Thank you.
Yeah, thank you. Thank you very much, Daniel, and thank you, Pim, as well. As Pim was mentioning, this is a continuation study where the first study looked much more at the numbers around water financing. And in this study, we're looking much more at the people and the other factors which are at play when decisions on water financing are made. Just to give you a quick overview of the presentation, we're going to start by looking briefly at the premise of the study, and then we'll look at what we found in the 4 case studies that we addressed. We'll try to draw that into the overall incentives which we saw at play, and then finally see how that translates into some potential recommendations for the sector and for stakeholders going forward. And just to say, the study was conducted by a team from Rebel Group and Trinomics in the Netherlands, and we were guided by a steering group comprising a number of water sector and finance experts, all of whom I believe are on the session today. You see a list of stakeholders there, and basically what we did, and a central part of the study was to actually have quite detailed and frank discussions with these stakeholders involved in water sector financing decisions. If we start off, as an end goal for the water sector, we would expect that there would be a natural transition over time in financing, that basically as local capital markets develop in countries and as the performance of water utilities improve, that there would be a shift towards a greater use of local financing. And when we use the term local financing in the study and in this presentation, we're referring to both local currency financing as well as to loans from domestic banks and especially commercial banks. So if we take this premise and if we try to visualize this transition as a trend line, plotting the improvement of utilities performance on one axis and the development of local capital markets on the other, we would expect that countries would be tracking towards this transition trend line of well-performing utilities dominantly making use of local financing. But what we tend to notice is that this transition tends to be held back and is somewhat delayed. And certainly in the water sector, we see much more substantial roles still for more traditional sovereign development finance, certainly than we see in other sectors like energy or in the transport sector. So through the case studies we selected, some of which are closer to this trend line than others, we try to look at what were the experiences and the factors and the processes for stakeholders involved in these decisions. Just to reinforce that, this transition towards local financing has a long way to go in many countries. The reliance on more traditional development finance, sovereign hard currency, is still higher than one might expect or desire for the sector. And this indeed comes with risks for countries, and it also is a factor in delays in creating the conditions for greater local financing to play a role. And coincidentally, we saw the very recent PF study of the water sector in Kenya. And this was quite topical because it shows on one hand the very small role played by commercial finance in the sector there. And also interesting that over the next years, the grace period on a lot of the development loans are starting to expire, and the country starting to face a fairly steep repayment burden, which is becoming a fiscal burden to the general taxpayers. So let's look briefly at the 4 case studies that we looked at. Obviously, there's a lot of information on the slide, and I'll try to capture the essence for you. So we selected 4 water financing cases from 2 countries in Africa and 2 in Asia, in different loan sizes, different uses within the water sector. And obviously, keep in mind, it's a limited sample of all of the water sectors and all of the projects in the world. But we tried to include a range of examples where we also saw progress being made towards local financing, so we would be able to better understand what was influencing and what was driving that. So in the case of Indonesia, this was largely a more kind of traditional DFI loan, a large loan in hard currency, basically sovereign to the national government, which was used by the Jakarta water sewage utility. In the case of Kenya, a very interesting case, being a small loan in local currency from a local commercial bank, so arguably very much what one would want to see, to a utility in Nakuru and linked with an OBA grant. The Philippines was a case of a loan made by a state-owned bank to the utility in Cebu, again in local currency. And finally, in South Africa, we looked at the case of a DFI loan. However, a DFI loan made in local currency to the eThekwini municipality for use in its water utility. And just to recap, in each case, we interviewed and spoke to the main stakeholders who were involved in arranging the finance and deciding on how to structure it, both from the public and the lender side. We didn't go into the details of the numbers with them, but we focused more on how the decision was reached, why it was chosen to follow this financing route, and what were the considerations that they took into account. So in each case, we were trying to look at what were the non-financial factors and incentives which were influencing the financing decision. We found quite a lot and quite interesting things in the study, and beyond what we can fully do now, but just to try to capture sort of the essence of what we saw in each case. In Indonesia, we were really trying to examine the factors that encouraged the continued reliance on traditional DFI lending. And there we saw that the financing decision was being made principally by the national ministries, more in the context of the overall public finance and development finance borrowing program, as well as in the context of quite long-term upstream relationship with the development, the DFI lender. And that while the loan was ultimately used for water, at the end of the day, there was quite a distance between the borrowing and the actual use. We'll come back to this again in a moment. In Kenya, we were interested in what had driven this process of a local utility successfully borrowing from a local commercial bank, even though it's quite a small loan. And this was interesting because in some ways it was procedurally easier for the utility to actually access commercial finance than development finance in this instance in Kenya. And also what played a sort of critical role to bring in the local finance was that the OBA basically had that as a specific requirement for the grant. So it served to de-risk the commercial bank loan, but also ensure that it actually happened. In the Philippines, we were interested in looking at how some of the systemic or market barriers presented obstacles to commercial banks. And there we saw literally competition from the local state bank and the market, and that the state bank basically enjoyed a competitive advantage over the commercial banks and was both an approver but also a provider of loans itself. And finally, South African case, we were interested to know what had motivated a DFI to lend in local currency without any form of national treasury guarantees. And that case really showed how the treasury could quite strongly influence the direction and the incentive structure for the water sector. And they were doing that in this instance by both pushing the financing right down to the municipal level so that there was automatically a closer connection between the loan and the actual use of the financing. And they explicitly prohibit foreign currency borrowing, which means if you're a DFI and you want to be active in that market, you have to lend in local currency. So we tried looking across the four cases then, we sort of noticed that there were some factors which sort of consistently seem to influence the decision-making process for the stakeholders. And this slide here just summarizes, in essence, the main thing we noted for each stakeholder. And we will, after this slide, go into each one in a bit more detail. But in essence, the national government and Treasury were not always doing enough to push local financing. The local utilities often didn't have much of an incentive to seek commercial financing if it was easy to get public or development finance, and hence there was not much market making or opportunity for the local banks. Let's look at each of these in a little bit more detail now. So for the national governments and Treasury, what we saw is that there's a risk of treating water sector financing as just a very small part, couple of percentage points of overall capital expenditure and public and related DFI financing. In some instances, there wasn't much effort to pass on the loan terms or the discipline that a lender brings to a borrower to the actual utilities and the water users. In the crudest sense, it's purely sovereign guaranteed loans where ultimately it's taxpayers who are going to pick up the ticket, and there's less relationship to the actual performance of the water utilities. So obviously we saw this quite strongly in the more traditional case in Indonesia, with a split of the financing decision between financing, investment, asset ownership, and operations. In the Philippines, though, we saw a step towards addressing this by having the financing run through a local public state-owned bank, which was a step towards more discipline. And in South Africa, we saw it go much further to actually push that right down to the municipal level and, in fact, prohibit the FX borrowing. If we look at DFIs, there's certainly agreement, it seems, at policy level that the purpose is to really secure a transition to local financing. And there's quite some things being done in that direction by DFIs. And I was interested to see, for example, EBRD is actually lent already in 27 different local currencies. So there's quite some progress that has and can be made. But it's a balance between trying to achieve that and on the other hand, the sort of disbursement pressure and the need to, or the ease with which larger sort of sovereign programmatic loans can be put together, which makes it easier for the investment officers to actually meet targets, but often also suits the Treasury concerned in that country. So there's definitely movement in the right direction, but a way to go with DFIs. And it was interesting to see that the measures of the Treasury, like we saw in South Africa, could really kick that along substantially. For commercial banks, they do invest to a limited extent in water, and many are interested in doing so, but the pipeline of viable borrowers and projects is relatively limited. And hence there's less interest to substantially invest in the sector. We also saw the cases, as mentioned earlier, where there's actual distortion in the playing field for commercial banks, with the case of Philippines being a strong example, where the regulator has to approve a commercial loan and charges 9 to 11% on the loan amount to do so, but it's also a loan provider itself. So some real perverse systemic incentives there. For the utilities themselves, we saw that often there's not much incentive to pursue local finance. It's often not available, and if it is easier to get public or development finance, it's often the favored route, and then only if all else has failed does a utility turn to local commercial finance. But again, the cases of both South Africa and Kenya were interesting to see how those influences or factors can be affected. So now, how do we sort of pull this all together into something like an idea of what to do next? I think overall we certainly saw a number of factors that seem to hold back the trend to local financing in the water sector, and it seems that it's not something for any single stakeholder to take on, but it requires actions from several stakeholders. So we saw treasuries play a really key role, and the measures that the treasuries take can either perpetuate relying on more traditional development finance, or can actually catalyze and push along local financing quite strongly. So there's a responsibility there in terms of setting the direction for the sector and taking concrete policy, regulatory measures, and so on. DFIs themselves are critical in this, and as we mentioned, there's certainly a push at policy level towards local financing, but there may be measures that DFIs can take in terms of their internal operational systems and structures, which would help to encourage that, so that there is as much incentive to make a smaller blended financing loan to a water utility as there is to do a 600-700 million program loan to a country. For the water utilities, I think what we noticed is that they are very responsive to the incentive structure they're in. And so it's not that they don't have a responsibility, they obviously do, but they are very much influenced by the framework set by the treasuries and the DFIs. And the local banks, it's sort of understandable if they have not been involved, if there has been less opportunity and maybe not a quite level playing field, but certainly one would expect their response in the future if that is opened up for them. So interesting is that there's quite a lot of intertwining and interactions between these recommendations and potential initiatives for the stakeholders. I think at the top of this is really the national governments, the national treasuries, and the DFIs, who need to really agree to a desired path towards local finance and then act through policies, regulation, instruments to move in this way. There's a context then for de-risking measures, various instruments, blending finance, co-lending operations to actually turn that into practice and to really help the water utilities along. As the water utility performance improves over time, we would then expect increasing potential and role for private financing and local financing. So if I start to move towards some form of conclusion to this, we did start by asking what is holding back the transition to local finance in the water sector. And we were interested to explore especially the non-financial, the non-number factors at play in the financing decisions. And certainly we saw that in the 4 cases, that there are factors, incentives in the setup of the sector, in the setup of the financial sector and treasury regulations, as well as in the operations of the institutions themselves, which influence the decision, which is not necessarily purely about the spreadsheet of the financing. And we've seen that there can be joint actions to try to head in a way which embraces local financing more. And this is obviously a long-term process, but if some of these sticking points can be neutralized, we think that that transition will be a smoother transition. So by way of closing and saying thank you, I want to just make one reference to a very senior water expert we spoke to at the beginning of the study, who has many decades of experience in the sector, and he had the following to say, and paraphrasing: what needs to be done to improve water services is rather practical and straightforward. Invest in improving the system, reduce leakages, improve revenue collection, set tariffs correctly, provide better services to users to increase willingness to pay and enforce payment, and so on. And the fact that some of these quite practical measures are not done sufficiently, I think speaks to some of these broader factors at play in the sector. We did focus more on the financing decision making, and there we do see that the DFIs and national governments, and especially treasuries, are key in this process. And I think there sits quite a opportunity and a responsibility to drive the sector far more towards local financing. Thank you.
Thank you very much, Rolf, for this insightful presentation. You're already getting positive feedback in the chat. Also from my side, an applause. Thanks a lot also for keeping the time, which I appreciate a lot. I think you've presented it very well. It's a very dense presentation, though, necessarily probably because of the subject and number of stakeholders you were dealing with. So thank you very much for highlighting the key messages. Now I would invite all the participants of this session, the audience, to ask questions. We have scheduled around 10 minutes for that. You can either do it through the chat. Katrin Gronemeyer will then take it up and remind me that there's something happening there. Or you can also raise your hand in the menu bar of the MS Teams application. You see that little hand in the middle. By clicking on that, we'll be able to see that you would like to say something. One first question I see already, whether there's a link to the study. I guess, I know Philip or Katrin, since you were in the organizing committee, I guess there will be a documentation of all sessions, and we will certainly share that link one way or the other with all participants of this session and also beyond. Yeah, I will ensure that we'll do that. So are there any questions concerning the content or the recommendations or the analysis presented by Rolf?
We had 2 questions in the chat during the presentation. The first one was from Mr. Van Doorn. He asked, with the international commercial private risk insurance market drying up as a result of COVID-19, do you think that this will increase incentives for local currency financing? And the second was from Tatiana, who's also asking, I mean, you mentioned already a few, but she asked what can be done to change the incentives of the stakeholders so that they will want to move towards local financing.
Okay, thank you for these 2 questions, Rolf. I suggest that you answer them now before we take up additional questions which are popping up in the chat.
Yeah, thanks. Yeah, the first on the COVID situation, I think, in general, we're in uncharted territories in a number of areas with respect to COVID. And I would think if it is less easy to get appropriate insurances or hedging, then indeed having a broader role for local financing would be logical, where your hedging needs are not there or less. In terms of what can be done to change the incentives for the stakeholders, I think that's in some ways what we try to capture in that set of recommendations, and especially in that box of interactions we showed between stakeholders, that it does require national governments and treasuries to take certain actions, but that should be done in, and I don't want to say coordination because it's a strong word, but it should be done in a same like-mindedness from the part of DFIs. Also because, just to be very clear, we do see an important role for development finance in the water sector. There's no question of that. It's simply to have it operating in such a way that more opportunity for local finance is created so that transition can happen. Yeah, as mentioned, I think the utilities are often quite responsive to these environments and these frameworks which are set by the treasuries and the DFIs themselves, and similarly the commercial banks. I mean, when there is more opportunity, they will be there for the lending operations. So I think making some of those changes, really starting at the top level, should ripple down to affect the stakeholders in the process.
Thank you, Rolf. I just repeat briefly, because Kathleen was commenting on this, we'll certainly share and circulate the presentation after we finished it via email or via the app as well for this conference. I just would like to pick up one question, Katrin, before maybe you can do that again, from Eberhard Goll. What should be the role of regulators in this context? That I was wondering that as well. Because they were not on the list of the stakeholders, so to speak, although many countries say they play an important role in regulating utilities. Maybe, Rolf, you could briefly answer that one, but we also can take it to the panel discussion later, because we'll have a CEO of a regulator on the panel as well.
Yeah, no, good question and good observation. And it reflects that not all countries have the same setup with water sector regulators with the same responsibilities and authorization. So some of the countries we looked at don't have an independent regulator. It's a function of the national government. Others have quite strong regulators. So they were people we spoke to, but we didn't make an overt comparison, partly because of the differences in the country setups.
Mm-hmm. Okay. Katrin, I leave it to you to pick one or the other question from the chat.
Picking, there were quite a lot, so I'm probably not going to manage all of them, but we'll have some for the panel discussion later. Lotte from Water Integrity Network asked on the role of national treasuries. Who from the sector do you see as the best position to influence them to reduce obstacles, change incentives? The utilities directly, regulators, national ministries, or DFIs?
Rolf, yeah.
Sorry, what were my options there? Just to, you said DFIs, utilities, or?
Utilities
the treasuries themselves
directly, or the national ministries.
Okay. Yeah, interesting question. I think, a lot of it sits with who the relevant national minister of finance is and what their sort of approach and policy positions are. So I think in some countries where you have the government explicitly seeing kind of traditional development financing playing a big role in their overall public financial management, there is going to be more opening for that in the water sector. In others, and again, South Africa is a good example where it's quite a prudent and quite disciplined treasury minister and function and role, which you then see flowing down into the system. So, I mean, a lot of it partly sits with the treasuries themselves, but I think DFIs do have quite some influence. Probably utilities to a lesser extent, again, depending a little bit on how the sector is set up. So I think there would be potentially most influence coming from the national level policy discussions and their position on overall sovereign debt, together with the interactions with the DFIs.
Thank you, Rolf. So more questions are coming up. We can still take 3 to 5 minutes. Maybe we can try to answer 2 or 3 more questions. Katrin.
Okay. So I'll take 2 together because they actually refer to each other. So Katarina Fonseca asked how we can move from the quick practical micro solutions, which so far have not led to the change we want to see, to the more macro regulatory institutional changes. And she asked, where's the big lever for change in your opinion? And that was again underlined by Simone Clavita, who then asked what would be the most important based on the case studies you have presented to mobilize finance through innovative and sophisticated financial vehicles and mechanisms. And maybe just to add on that, if that's not too much, Dick van Ginhofen asked whether you see a role for local currency treasury bonds to replace FX DFI financing.
Yeah, I think a little bit cutting across all three of those questions, I would say that we also need to be realistic about this. It is not going to be a situation where in the water sector we can go from the current mix of financing to dominantly local at-risk commercial financing overnight. I mean, that is going to be a substantial transition. It needs some behavior change from the stakeholders in the way we've been discussing now, but it also needs the development of interest from the local finance market, the development of adequate security packages, which is going to bring that capital into the sector. And that is by definition a slow process. So I think cutting across all of these questions, both with respect to what will drive the change, as well as potential new products that can underlie greater local capital involvement. I think it is simply a case that we have to keep doing the small measures which are being done, but ideally start to do more of that and incrementally create more of a momentum, more of a sort of market making for the sector and get back onto that track. If you remember, we were saying the correlation we'd like to see is a correlation between local utilities increasing their performance and local capital markets developing, and the two coming together, so that at some point in the future we achieve an end goal where most financing is coming from local financing sources, with still a role for concessional finance and sector support and grants and so on. I think that will always be a factor in the water sector. But we can get far further in the transition. So I think the drivers are sitting in some of the achievements which are being made. They're sitting in the actions by the stakeholders who are involved, and maybe they're sitting also in that risk that the PF study of Kenya underlined, that a lot of these grace periods on the traditional development loans are expiring, and there's going to be this growing fiscal burden. And maybe it's something like that which can be a real push and a trigger to look for better alternatives.
Okay, thank you, Rolf. I think, given the time, I would suggest that we now move a step further. I think we can still take up some of the questions in the chat during the panel discussion. So just give me a second. I would like to just show the presentation. I think got somehow lost now. 1 second, please. Okay, here we go. Maybe, Katrin, in the meantime, you can take up the last question from Lamine in the chat, which is a very interesting one, while I'm busy with uploading the presentation again.
Yeah, basically the last questions, well, one overarching question that a lot of people had it, where do we then start if we look at micro activities, especially on local financiers and utilities? So what are the measures we can do now? And the second question is, which of the stakeholders would be the most difficult to convince to change the paradigm? So where is the really hard to convince people there?
So Rolf, maybe for this last question, what do you think was the most difficult to convince from these 4 stakeholder groups?
I must confess I was busy adjusting things in my office, so I missed the question.
Who of the 4 stakeholder groups is the most difficult to convince from your point of view of the necessary changes towards local currency financing? Maybe keep it short, the answer.
Yeah.
Let your stomach talk.
Yeah, I think the difficulty may sit especially in the interaction between some treasuries and some DFIs. I think that may be a really difficult point where the development financing that is being provided and also sourced by that country partly goes to the water sector, but really is in a whole broader mix of public financing for that country. And then there become many other factors involved in why they might want to continue with that modality. So I think there's quite some challenge. In fact, it's interesting. A lot of this seems to sort of consistently track back to treasuries and DFIs and their interaction. So I think that's where a lot of challenge, but therefore also opportunities sit.
Mm-hmm. Okay, thank you. So at the top. Now we move to the panel discussion. Thank you once again, Rolf, for this presentation and for answering the questions. Yeah, we have we planned with 5 panelists representing basically the different stakeholder groups. In addition, also, as I mentioned, we have with Robert somebody who represents a regulator. Unfortunately, Oswald Chanda needed or had to excuse himself this morning for health reasons, so we won't have him on the panel for perspective of a DFI, but I think we have, I've seen that some people here are also working at DFI institutions. I myself maybe can bring in some experiences or insights from the German Development Bank, KfW, so we'll try to compensate a little bit for that. And then we have 4 panelists, which would like to introduce briefly. Dr. Josienzo Ramogopa, welcome to the session. He's heading the Investment and Infrastructure Office in the Office of the Presidency of South Africa. Interestingly, you were also mayor of the city of Tshwane, and you were one of the youngest mayors of a metropolitan in South Africa. That was something I found pretty interesting. And you also like to be involved in soccer development in your home township. That was something I found quite interesting. So welcome. Then we have Nelson Irungu. He's relationship manager at the Cooperative Bank of Kenya and handling the water and sanitation sector. So Nelson, you're representing the commercial financiers perspective, and Kenya was also one of the cases. Welcome also to you. We have Robert Kakubia on the panel. Robert is the CEO of the Water Services Regulatory Board in Kenya, an institution I worked with myself personally some years ago. So I'm glad to see you again, Robert, at least virtually. Before that, you were the director of water services at the Ministry of Water and Sanitation. So you can also possibly help to ship in a little bit the government perspective from your point of view. And what is interesting that in Kenya, you are one, I think, of the key persons also who supported and shaped the water sector reforms over the last decade and more. And then we have Lamine Diallo. Lamine, you're working at Somajep, which one could translate as the urban water service provider in Mali. So your company is operating the assets in urban areas. So you're representing the utility perspective to some extent. Welcome also to this session. I would like to start the panel discussion maybe with Dr. Josienzo Ramogopa. I hope you can hear me. Maybe just confirm because I didn't hear your voice yet.
Yes, I can hear you very well. Thanks. Yes.
Perfect. Connection is fine. Great. Yeah, maybe from let's say national government perspective, or possibly also from a little bit from a treasury perspective. What do you think of these recommendations? Are they feasible? Are they realistic? What are the key bottlenecks and opportunities from your point of view?
Well, thank you very much, and good morning to the panelists. Thanks for the invitation. Just to say that the presentation was particularly useful. I think it provided an examination of the role of the various players, if you like, stakeholders in the space, and what their contribution could be in enhancing financing in this sector. Let me just state the following. One is that in the South African context, the provision of water, and I'm talking about reticulation and essentially the water infrastructure, mainly water treatment plants and wastewater treatment works, resides with the local municipalities. So they're the ones who've got the original constitutional mandate to provide that kind of infrastructure. I think in the main, there are three areas that undermine the participation of the commercial banks, the DFIs, in funding infrastructure in this space. The first one is that the balance sheets of these many municipalities in our country, I think we've got about 256 of them, has deteriorated to a point where they are not confident to go out into the debt capital market and raise financing for purposes of funding municipal infrastructure. And perhaps in the course of the panel discussion, I can expand more on that. And then the second one is the underpinning revenue streams. So in the country, there is a policy determination that we need to provide universal access. I think since the victory of the democratic, we've been able to take access for water and sanitation, at least water from about 46%, and now we're sitting at about 87%. So there is still a delta of 13%. And the majority of the people that are excluded and then have access to clean potable water are typically located in your rural areas, and also the municipalities that operate in those spaces are some of the poorest in the country. So it's very difficult for these municipalities to raise money in the debt capital market. And even if they had the skills to do that, your underpinning revenues are not compelling to a point where the commercial players would want to come into that space, because one of the politicians in this country is that the poor's access to water is almost 100% subsidized. So there is no revenue stream. They tap from the national pairs to be able to fund that. And then the third area is around the skills required. So I think we are understating the requirements that relates to properly packaging projects to a point where they can attract commercial players, the MDBs, to come into that space. So even in instances where the revenue streams are compelling, I think in our country we have a problem in the public sector that we have hemorrhage a lot of technical and financial engineering skill, and there is no capacity for the municipalities to do exactly that function. And just in conclusion, just the 2 minutes assigned to me as part of the opening remarks is just to say that perhaps eThekwini, which is the municipalities that served as one of the case studies, is an outlier. It's not reflective of what is essentially the general experience of the 200 plus municipalities. So in the country, you've got the 8 big metros. So these are the big cities. There's a lot of industrial activity, commercial activity. And I think in those areas, you are able to have strong and compelling revenue streams that can be confirmed. They are certain going into the future. But also these municipalities are able to attract some of the best skills, and they also are sitting on a healthy balance sheet. But the majority of the municipalities in the country don't have that luxury. So what are we doing to resolve this problem? So we are proposing the office that we need to drive a national program on water infrastructure. So Essentially, we are lifting these responsibilities from the municipalities and ensure that we pull that at the national level. What are the benefits? Two principal benefits. The first one is that we'll be able to bring to bear the kind of skills that are available at the national level to provide, if you like, a transversal function so that we're able to package these projects better. Secondly, is that there's going to be strength in numbers, just the scale of the infra in that space. And lastly, is that we're able to introduce credit enhancing instrument, because I think National Treasury in the country have come to the realization that there's been almost complete collapse of water infrastructure, municipal water infrastructure. So we'll introduce, we're proposing to introduce credit enhancing instruments, and principally there we're looking at a sovereign guarantee so that we're able to attract the funders into that space. And then the last one is an initiative that we introduced about a week ago. We are now where we have set aside 100 billion rands, about $6 billion US for purposes of blended financing to assist in project preparation and packaging, and hope that we'll be able to crowd in private sector. If identified the water as one of the priority areas for funding. Let me leave it here for the opening remarks. Thanks.
Thank you, Dr. Pacienza, for these remarks and also for advocating for a strong role of the government to change the situation. And Nelson, the private commercial banks or local financiers were also touched upon as an important stakeholder group. I think in Kenya, we also heard that there are first experiences with commercial local currency lending to utilities. Maybe from your point of view, what is your experience with utilities and municipalities commercial lending? Do you think the recommendations we have heard, are they doable? Do they point into the right direction?
Thank you very much, Daniel. I hope you can hear me clearly.
Please speak up a little bit, your voice as well.
Thank you very much. Can you hear me now?
Perfect, thank you.
Thank you so much for the opportunity to present and to discuss about the recommendations that have been put across by the Rebel Group about the commercial banks in Kenya and elsewhere and funding the water sector. And the presentation that has been done by ROF was just very good and very insightful. And I think they did their work very well. Thank you so much. Under these recommendations that have been put across, I would like to first of all to state that we have had an experience as a commercial bank in lending in the water sector for the last few years. And basically, we could be one of the few banks that are doing that. And we have had to learn on how to take care of the water sector, because it has not been somewhere where the commercial banks has the space where commercial banks have been in the earlier on in the years. And the recommendations that have been put across are quite interesting, and I think they can work. But allow me to speak about the bottlenecks that have been there. One of them, which has been highlighted as well in the presentation, is a lack of understanding by the commercial banks of the water sector and how we can lend to them. The second bottleneck that has been there is the revenue that comes from the water sector. And that would require that we up our game as the WSPs, that's the water service providers, in the way we collect the revenue, because this one would form a very good basis in terms of lending to this sector as from the private bank's perspective. And also lack of information. I would say there's a lack of information on the capacity of the borrowing capacity, of the utilities. Now, the lending policies of commercial banks have not been very friendly to the public sector.
Now we can't hear you anymore, Nelson. Are you still there? Okay, let's wait for a few seconds. Nelson, I don't know whether you can still hear us. We can't hear you anymore. Maybe the connection to Kenya, or at least to your office, is somehow interrupted. I hope everybody else can hear me, and it's not my side the problem. Katrin, can you still hear me? Is the connection still there?
It's not on you. I think Nelson is back as well.
Okay, Nelson, are you unmuted? Because we can see a picture, but we can't hear you. Just double check. Okay, now we cannot hear you, sorry. We can't hear you, Nelson. Okay, so maybe we try to give you time for a statement later on. I think you have logged out now. Okay,
Okay,
but I think now you're back, Nelson. Okay,
I'm back. My apologies. My apologies. I think the network did something.
Yeah. Okay, now you can continue. Now you're back. Great.
Yes, I was just about to conclude on the opening remarks. I was saying that we will require. I think that more opportunities are coming up to lending to the water sector and more understanding. And as a pointer, the OBA projects that we have had have worked very well in the country in making commercial banks understand how to lend to the water sector, and that the water utility companies are actually lendable. And that has been a great influencer in the commercial banks in Kenya going that way. So as we continue the panel discussion, we will discuss a bit more. So that's my opening remarks. Thank you so much.
Thank you very much, Nelson. We have a second voice also, and second perspective also from Kenya. Robert, can you hear me? Are you there?
Yes.
Great. Robert, you have been working for the last 12 years with the Water Services Regulatory Board, or you are heading it, leading it, and I guess you know also sector discussions well beyond immediate regulatory issues. Maybe first question, what could a regulator add to the recommendations? Where could the regulator maybe help to facilitate local currency financing? And yeah, maybe that's the first question for you.
Thank you very much, and thank you for the presentation. Perhaps I would like to say, and I basically mostly focus on my country here, because we have done quite a bit of work as far as water sector reform restructuring is concerned. Of course, there was a major, I don't know what to call it, misunderstanding, but when it comes to the roles of the various stakeholders, in this case, especially government and the utilities. For government, there was this misconception that once you restructure the sector, then your role is more or less not much. When, in my view, and from my experience, that is when really, as government, the government should have come in very strongly to support the aspirations of the reform. And those aspirations really were to deal with whatever problems the sector is facing. And one of the problems, which is the subject of discussion today, is financing. There was also the misconception that even discussing about other sources of finance means that the government role of financing the sector is diminished, and nothing could be further from the truth. And I think this is one of the challenges that is facing us as a country. There is that thinking that if utilities are able to access commercial finance, then government does not have to do anything. And I think at least in the short, medium term, there is need for public finance to actually support this transition now to commercial finance for the sectors. And the regulator's role is basically to kind of provide the analysis, provide the information that puts the sector into the proper perspective, and kind of tries also to facilitate that discussion based on information, based on verified data in terms of what we are doing. A lot of problems in the water sector in Kenya have to do with basics, the issues of revenues, the issues of operations in terms of efficiency and in operational performance, and the issues of governance themselves in terms of the leadership that we put in the utility itself. you'll find that even the utility that has been that was part of this study, it has been very well managed even before the reform started. In fact, it was a pilot case among about 5 or 6 others for the reforms. And even when we now have, even when the system of governance changed in the country, where we have 2 levels of government, it has really continued to shine because there has to be very, very clear separation between the government ownership and the operations of the utility in terms of delivering what it's supposed to deliver. It doesn't mean that we do not take cognizance of the political issues. We do, but a number of these political issues can sometimes undermine the drive towards, first of all, efficiency in the operations, drive towards a cost recovery tariff in terms of making sure the utility is able to sustain its operations, and in terms of the drive towards better governance and better leadership and management for the utility. These are some of the things, perhaps, if they are worked on as basics, will actually help the transition and the road towards local financing and especially commercial financing. But I must reiterate that the government plays a very, very strong role. We are trying. A sector has been quoted by the study. A study has been quoted by this study that in terms of the water sector debt, which we actually coordinated as a regulator. And I want to say that it is not easy to bring in government to discuss, but it must. I must say, it must. Otherwise, then the sector will at some point now just collapse in terms of financing, and you basically not really have nowhere to turn. But the government really must bring in that leadership, must come into that leadership role. But this is also not, it should also be strengthened by our DFIs, because I've seen a very difficult discussion between DFIs in terms of we continue financing the sector. Our sector actually has more than 80-90% concessional financing. That means the government finance, where most of these are loans, so that we will pay, but the public finance from the local public finance is not as much. And this is not a sustainable model for the sector. But this is not replaced by commercial finance. It must be replaced by government upping its game on financing and trying also to lead from a strategic perspective the sustainable financing for the sector. Thank you.
Thank you very much, Robert. I think you're highlighting, from what I understood, 2 very important points. One is that there was this recommendations utilities should improve performance, but this depends whether they're able to do that. This depends on the basics, as you call them, the foundations of good utility governance, of efficiency, revenue mobilization, and also you highlighted that local currency financing does not only or does not relate only to commercial financing, of course, but also a lot to public funding and, of course, tariff revenues, which are coming also in local currency. Lamine, the last opening remark, you are presenting a service provider. Are these issues, which also Robert raised, constraining Somerjet to borrow in local currency? Or maybe you could give a bit of insight from your perspective. Lamine, are you there? You're able to hear us? I don't know whether you're talking, you're not, are you possibly still muted? Sometimes people forget to unmute themselves. I forget it sometimes as well.
Yeah.
Okay, now, yeah.
Yeah, I can hear you. Good morning, everyone. So in case of Somerjet, concerning the financing of the drinking water sector, unfortunately, Mali is no exception also to this vicious circle. And I congratulate, by the way, the initiator of this topic for the choice of this critical theme. We have been fortunate in Mali since the reform of the sector in 2010 to see the creation of two companies. One asset company, which is in charge of investing in big assets that get transferred to the second company, which is my company, the water distribution company. So we are more or less on the right track for this. The major structuring projects in Bamako, which is capital, start 1 year ago and was financed by DFIs. And I think the solution must be holistic, as I understand, because our local bank are not interested at all to provide long-term financial solution for the company for different reasons. Some might be because of the lack of treasury, sometimes of cash flow that the company are suffering. Sometimes might be also from the side of the bank that they don't have the knowledge or the skills to assess such company, or they have no interest at all investing in long-term perspective in our company. But despite that, I think the main structural problem comes from the regulator and the government, because we don't have a clear contract that are well defined with KPIs that are respected by all stakeholders, the government and the utilities. So it's this is one of our problems. So the loan that we are most of the time are getting are not based on the performance of the companies, but they are just linked to the relation of the government between the government and the DFIs. So we need basically to make our government understand, or the regulator understand, that there exists other way to get the financing of the water sector. Mm-hmm. And we also definitely will need to implement a financial model that guarantee the balance of the sector. Balance of the sector means which price will be sustainable to enable the asset company to continue doing investments, and the utility, for instance, so much to keep running properly. So these are major questions that's on the table, and the bottleneck is basically coming from the regulator side or for the government. And but we are a utility also needs well-defined KPIs for the financial viability of the company. So because one of the main problems is that the price of the water actually is not allowing the companies to have enough cash flow basically to get one. So this is giving also a bad image from the company basically for the local bank or for local finance company. So these are main struggle or problem that we are facing in the sector, and it's as I say in the beginning, it's need a holistic approach. That means all stakeholders should maybe work together to the main objective. Thank you very much.
Thank you very much, Lamine. I think what you're saying is also a little bit representative for other countries. Loans are not based on performance. Tariffs are not reflecting sustainable levels, and that also points to, of course, to governance issues, which Robert touched upon. Katrin, maybe we can take up 2 or 3 questions which are addressed to the panelists, and before we have unfortunately closed the panel discussion already.
I have two questions for Dr. Ramogopa and one to Robert and then one to all panelists actually. So I'm just going to go through them and then you can already think about your answer. So first from Dick van Rinhoven to Dr. Ramogopa, just a clarification, he asked whether sovereign guarantees are provided by the central government to local municipalities, utilities for local currency debt financing when creditworthiness of the municipalities or utilities alone is not enough. That's the first one. And the second also to Dr. Ramogopa is whether the national government in South Africa plans to provide support to local municipalities once the finance roll in. Then third question to Robert Kakubia, also from Dick van Rinhoven. He is asking whether he heard you correctly saying that DFI financing is not a sustainable model for water sector finance in Kenya, and what alternative model you might have in mind on that. And then a question to all the panelists by Simone Clavita, who's saying that lending, even with local markets, replies return on investment, which brings the question of affordability of services. What fiscal instruments with distinctive capacities to address the social dimensions of paying for water supply and sanitation service are in place in the countries represented by the panel members?
Okay, thank you for this question. Thank you, Katrin. I think we won't have the time, Simone, unfortunately, that all panelists will answer. Maybe we can then ask Lamine to answer the last question. Dr. Ramogopa, maybe you can briefly answer the two questions addressed to you.
Just a quick one. Thank you very much for the questions. No, the current dispensation doesn't permit for national government to provide for sovereign guarantees. So what I was saying earlier on is that we are putting forward that proposal to national treasury. Our office is assigned the responsibility of looking at the necessary reforms that can allow us to invest more into infrastructure, in particular the water space. And in relation to the support to municipalities, yes. So our office has been inaugurated for exactly that purpose, so that we are able to aggregate the skills and, if you like, provide the transversal functions across the municipality. So we are going to crowd in the office so that we are able to, as and when required, unleash those skills to go and provide the technical support to the various municipalities in the country. Thanks.
Thank you very much for that brief answer. Robert, what is the sustainable financing for Kenya of the water sector, in a few words, beyond DFI financing?
I don't believe that you can, as a sector that relies 90% on development, DFI financing is sustainable. I think the government really must come in either, first of all, to kind of increase its financing, the public financing for the sector local, and then also to facilitate an environment where utilities are also able to access local financing, not necessarily from commercial banks, but also from the capital markets and all that, but of course with favorable conditions. I really do not have, I don't think it is an easy thing, but it is something that we have to think about if we are going to have a sustainable financing for the sector.
Mm-hmm. Thank you, Robert. And then I would suggest that Simone's question, Lamine, that you maybe take it up, which was about also the how to maintain affordability.
Yeah, but at the end, when you go to the rural or the urban consumer in Mali, basically, you will see that payment for water is not a big problem, and people pay more sometimes than the price charged by the utility when they go through a private individual or others. So the key question is, therefore, how to define a business model for the sector that allow for large ongoing investment to improve access and to strengthen capacity of management companies and maintain perhaps investment and lastly to reassure the consumer through the transparency, communication, and a good service providing. In simple terms, people will be willing to pay a few more cent per cubic meter if they are connected continuously and they have a good service quality provided and a good communication behind.
Mm-hmm. Thank you, Lamine. I would love to continue the discussion, but unfortunately we have to move on to the way forward. I put in the chat the offer that you can send further questions in case they were not yet answered to me, to my email address. I will make sure that I will forward them to the panelists or also to Rolf. Bill, are you ready to try to make sense of all of what we heard during the presentation, during the discussions, to tell us a little bit what is the way forward from your point of view as a former lead of the water practice at the World Bank, and now I think you're an advisor, senior advisor to the Sanitation Water for All initiative. What can we learn from all of this? What should be the way forward?
Okay, thanks, Daniel, GIZ, DGIS, consultants and panelists. It's a great initiative for a very important topic to all of us. I'm here today representing SWA, which is Sanitation and Water for All, yet we see Sanitation and Water for All is still some way off, and we see declining coverage with pipe supplies in many urban areas, particularly in sub-Saharan Africa, and utilities simply can't keep up with urban growth. Now, we know many of the reasons, and we've heard today about issues of policy, efficiency, cost recovery, institutions, and governance are all necessary alongside finance. But what I wanted to do, because time is short, is really concentrate on some next steps, where we might go from here. And it may sound obvious, but we need to reinforce the message that governments are responsible for providing services to all their populations. And this requires strong leadership and continuous leadership right from the top to provide clarity of purpose to all stakeholders and to overcome barriers to change. We need only look to India and the Swachh Bharat mission to eliminate open defecation in India to see that massive nationwide change is possible, and there are other examples. Now, the discussion today is about domestic finance, and partly that's to overcome foreign exchange risk. But I'd like to highlight another important aspect of this, which is that it broadens and balances sector accountability to include an important new stakeholder, which is financiers. And this will help improve sector governance in itself. We also heard that local currency borrowing appears expensive in terms of headline interest rates, and it has short tenors, and this puts upward pressure on tariffs. Now, to address this, governments need policies that support blended finance regimes through targeted and time-limited subsidies, whilst the sector can transition to full cost recovery, which is our long-term goal. Now, those policies need to be clearly articulated, and importantly, they need to be enforced. And they also need to be a lot more nuanced than we see today. So, for example, we need to recognize that all investments are not equal. A large subsidy is likely to be required when expanding sewerage. It's incredibly expensive and there's a low willingness to pay. But if you're investing in energy efficiency with quick paybacks, the need for a subsidy is less obvious. Likewise, governments need to recognize that not all communities are the same. For example, communities with low coverage require more subsidy than those with high coverage. They face larger investments and have a lower revenue base. So public funds are limited, they need to be used strategically, So a well-designed subsidy policy to blend concessional and domestic finance is a critical next step as we move forwards. We've heard about incentives. So governments need to design incentives that change the current behaviours. So subsidies can be used as matching grants that reward mobilisation of domestic finance or steps towards creditworthiness, as we saw today from the Kenya example. But I feel those incentives need to be targeted at the right level. Working hard so that my utility can access more funding is one thing. Working hard for the same end, but receiving a bonus in my pay packet is another and possibly stronger incentive. And incentives can only go so far. Even the most generous incentive scheme can be ignored. So the carrot needs to be backed up by a stick. Sometimes governments must introduce mandatory requirements if incentives aren't working. In Chile, for example, full cost recovery was enshrined in law. So another step forwards, well-designed incentives backed by mandatory requirements needed to make sure that progress is being made. Now, attractive hard currency borrowing terms are difficult to ignore. I've seen that. But governments need to include a forex risk premium when on lending to utilities in local currencies. We talked about the Philippines this morning. The peso was 103 peso to the dollar a year ago, and today it's 108. That's a 5% change. So if this were added in the on-lending terms, then domestic borrowing itself will start to look more reasonable. So governments need to price in forex risk alongside other commercial risks when on lending hard currency loans in local currency. As we heard just now, banks and water utilities don't actually understand each other or know each other. We therefore need to introduce domestic banks to the water sector and vice versa, and show them that there are opportunities for lending. And COVID may be actually causing a decline in traditional investment opportunities. And perhaps banks may start to see that water supply and sanitation is a sound and attractive investment opportunity. And I think utility managers may also find that the speed and flexibility of local borrowing is more attractive than DFI-based schemes. And then finally, as we noted in the presentations, DFIs have to support this agenda as part of a coordinated approach. We heard governments have to do things. This has to be a coordinated approach with the Ministry of Finance and with the Ministry of Water to wean the sector off hard currency lending towards financial self-sufficiency based on domestic borrowing. So in summary, high-level political leadership that will create the demand for finance. Promoting blended finance through targeted subsidies, providing incentives to mobilize domestic finance and improve performance, mandatory requirements if needed to back these up, properly costed forex risk adjusted on lending terms, dialogue between banks and utilities, and getting that consensus with DFIs for a consistent national approach to financing the sector. Thank you very much.
Thank you, Bill, for this, very well presented, summarized, let's call it maybe a strategic agenda, for changing financing in the sector. Pim, before we close, because we have to close, because the other session is about to start, would you support Bill's agenda, what he presented, and what's your maybe last thought on what we heard today? Please keep it to 2-3 minutes, because I don't want to steal too much time of the other session.
Thank you very much, everyone. I think we've made a huge step forward. We have taken this discussion from a closed meeting in Stockholm with a few people to a very broad, open online debate with over 120 participants I saw, and many of the participants belonging to the main stakeholder groups mentioned in the study. So I think that's a huge step forward. And further on the way forward, I sort of envisage two streams of work, one at the more at the global and regional level, and one at the country level. I really want to call on all of you, many of you members of regional and local or regional and global networks like Sanitation Water for All or MCOW, or as participants in the OECD Roundtable on Finance discussions, to take the findings of this study forward. Share that within your networks to create the needed awareness, political will, and like-mindedness to find this new pathway to financing the sector. So I really hope you all contribute to that. Secondly, at the country level, I really like to get back to you basically to gauge the willingness to follow up on this debate at the country level. Collectively, I'm sure we can identify several countries where some of the preconditions Bill mentioned, like the political will or strong effort in water utility efficiency is already ongoing, and where this discussion and the lessons we've shared today come in timely to help shape the new pathway to financing SDG 6. We all know, and it's been mentioned, that this is very complex, so we don't have to do a complete overhaul of the sector in one go. But at least if we, at country level, continue to create a political will and contribute to behavior change around financing, and take small steps, for example, first looking at the easier parts of the sector to be financed commercially, like non-revenue water or energy efficiency, I really think we can make good steps towards changes in financing SDG 6 and reaching the goals ultimately. So really want to also call on you to come with suggestions of countries where you see there's this potential to work together towards these goals. And I want to keep it to that and wish you all the best, and thank you for participating in this meeting.
Thank you very much, Pim, for this call to action. I think the discussion is just about to start, and we will hopefully make practical steps forward. Just a very short teaser. You're welcome to join the other sessions today in Water and Finance. We will now continue with a session on technical financial cooperation cases. I have to switch to that one as well. But thank you very much again to Rolf, to the panelists, Pim and Bill, for being here, for sharing your perspectives. And I'm excited to see what the other sessions will bring to the table. And I wish you all a nice day, afternoon, whatever it is, time it is in your case. Goodbye, and thank you very much.